the AIF has grown 7 times in the last 5 years as HNI scout for diversification. So AIFs are what? Alternative investment funds. And these are good investments for sure, because most of the AIFs, they are called AIF because they are alternative. Alternative to what? Movement of the stock market up and down. They're also an alternative to movement of the interest rate going up and down. My name is Arpit Arora. I'm India's leading personal finance expert and passive income coach. And I'm on that quest to change the middle class of India and transform their financial life in such a way that they are able to have the potential to follow their passion. They have the focus to follow their passion. They are not distracted by money because they're creating enough passive income. And most importantly, they're able to live with inner peace and joy. And that, my friends, happens by winning the game of money. That happens when you upgrade your financial IQ, and that most importantly happens when you are committed to achieve financial freedom in your life, because it cannot happen without a commitment. And it is my commitment to make sure you get all the support that you need to walk and achieve that destination. So they are most unaffected because of stock market volatility and interest rate volatility. That's why they're called alternative assets. Now, if you want to invest in an alternative investment fund, what's the biggest problem? And they've given good returns as well, not that they haven't. Here is a problem. The minimum investment into that is 1 crore. That's not a small amount for sure. 1 crore rupees. Even if you have 1 crore, you don't want to invest all of the money into giving it to one company, right? Even if you have 10 crores, even then you should be extremely mindful. I feel AIFs are only for those people, if you were to give it to an asset manager, unless you don't have 15 to 20 crores, AIF is not even for you. Because you need that level of asset, sub-asset and product level diversification. So which obviously the AIF is not able to give you because your capital is less. Well, it is able to give you the returns, but you are taking too high a risk for those returns, or you're giving all of your money to one company for those returns. You don't want to do that. So today I'm going to show you 5 ways. How many? 5 ways through which you don't have to invest in 1 crore and you will be investing into an alternative asset. 4 of them are pure alternatives. 1 of them is not so pure. I will tell you the pros and cons of it, and I will tell you what is the right strategy that you can play with it. AIF or alternative assets should be a part of everyone's portfolio, but not the 1 crore AIF. Even if you have a 10 lakh portfolio, even then you can have AIFs in your portfolio. But which ones to choose, which one is the right for you, we're going to discuss 5 different options, right? Are we all ready? So we've discussed those in fragments in the past. Today I'm going to bring it all together so you can, see all of those 5 different aspects and see, does it fit well? What are the pros and cons of it? And how can you go about it? The first very common one these days is peer-to-peer lending. So how does peer-to-peer lending work? I'm going to show you the whole thing step by step. So when an individual the step 1 of peer-to-peer lending is when an individual wants to lend money, they open an account with a peer-to-peer platform. Or rather, let me first tell you what is peer-to-peer. Peer-to-peer is person to person, individual to individual. So the step 1 is you open an account with a platform, which is a P2P platform, as a lender that you want to lend your money. Then those who require a loan register themselves as borrower. So like buyers and sellers both come on the platform. Then what happens? The platform evaluates the borrower's risk profile, and mostly using tech-driven like AI these days. The AI will define ki uska credit rating kaisa hai, how much money is he making, what kind of expense will he have if he lives in this region, all of that. So they will see the worthiness of the person borrowing the money from you. Step 3. Based on this assessment, the credit worthiness is decided and it is assigned appropriate risk bucket, which means ki high risk, low risk, medium risk, different type of buckets are defined, and obviously accordingly the interest rates will also be there. So the registered borrowers, which is you, rather the other side of the people, and investors, which is you, can send proposal to each other with relevant information on loan amount, interest rate, tenure, etc. The platform may also match borrowers with lenders on its own. So this depends on platform to platform. Certain platform will say this is a high risk borrower, 18% recommended. Tenure recommended 1.5%. And then you can discuss amongst the two of you. Or they will give you, the borrower themselves will say ki mujhe, I need the money for 2 years and I'm willing to pay 15%. Like that. So if the proposal is step number 5, proposal is approved, the two parties sign a contract after they agree on the amount, interest rate, and even time rather charged for the same. Then step 6, the lender starts receiving regular loan payments and the borrower as per agreed terms. Step number 7, the platform continuously monitors the profile and assists recovery in case of default. This is peer-to-peer lending. Right. Now, what are the options? What can one do? One, there is option like Cred, which is probably the safest one that I know, which I looked into and I still did not like it. They were giving a return of 9%. There are other peer-to-peer lenders as well, which give as much as 15% too. So you can make this money monthly. It can be a source of passive income. But these are unsecured. So that's one thing we need to learn. Lend & Club is one such company, and they say their default rates are 3 to 6%. Now, this might be decent, 3 to 6%, but the first thing is, especially when it comes to debt, I feel the return of the capital is more important than return on the capital. अब पैसा ही आपका capital ही नहीं आएगा वापस, तो उसका क्या फायदा? So the risk return, this particular instrument, these ones that they have it's maybe better than giving it to one individual without doing your own research, like people typically do peer-to-peer. This kind of formalizes that industry. So better than finding a person by yourself, these people, this platform will be better. But it's still extremely high in the risk-reward ratio, because if you want a 10-12% ka return, there are corporates you can give your money to and they can give you a secured bond, like we are already investing in. That is a better method. Why should I go for unsecured and 15? I should go for secured and 12%. If that is really the case, at least I know my money is going to come for sure. So that's one thing. Which is why I don't like peer-to-peer as much, because the risk-reward ratio does not match. If I didn't have those options, then maybe I could have considered this. Like we have options of Edelweiss, IIFL. These bonds are giving 12%, 10% returns. Even PVR was giving 10% returns. And I have personally invested in all of these. At least I know, I've researched the company, I know their financial background, I know everything end to end about the company. I don't know all of these things about the individual borrower, and the person can always default. I'd rather invest in a very big corporation whose financial strength I know before I invest, and that too is secured, right? So it makes better sense. The risk-reward ratio is much better in NCDs as compared to this. So second option, let's look at fractional real estate. So what is fractional real estate? Like you, rather than buying the entire property, you buy a fraction of the property. Rather than buying the whole building, you buy a particular part of any part of the building or fraction of the building, which does not mean you get a unit, particular unit. You're just buying a fraction of it. So there is no registry required. You just become a partial owner, a fragment owner, not a specific place owner of that particular building. So this, in other terms, is also known as REIT in India, Real Estate Investment Trust, is a method to do it. Isme kya hota hai? Step 1, the platform identifies prime commercial real estate for purchase. Then the property is listed as a fixed valuation on the portal. Then interested buyers put a token of money to express their interest to buy the property. Step number 4, I kind of skipped here. 5, once I think they go for subscription, they get it listed on the exchange or unlisted, maybe ho jata hai REIT. Then the subscription is mobilized, the investors put their rest of the money that they have committed into it. They create a SPV, special purpose vehicle, and in the proportion people have invested, they get that particular fragment. Then SPV acquires the asset, and the asset is handed over to professional property manager. Finally, step number 7, for the whole reason why you did that in the first place, you get rental cash flows from the property, which is distributed amongst the co-owners proportionately in the proportion of the money that they invested in. So what are the options here? We're talking about unlisted, like Strata kind of does that. We've spoken tons about it in the past. Even REITs, like we have 3 listed REITs in India which are doing that. So if you look at, this is Strata, so they have a recently closed deal of office space in Bangalore. The minimum investment was 30 lakhs. It was almost a 60 crore total yield deal. The gross rental yield was 8.8%, and they add another 5% onto the appreciation of the property, and they say that 13% is the return you should get out of it. Or an open opportunity they have in Chennai, which is minimum investment 25 lakhs, 30 crore deal. The rental on that is 10.6%, which is quite high. And they expect in conjunction with the value appreciation, you should get about 13%. So this is Strata. The other option is REIT. Now, the problem with these is that how do you get to know the worth of what you're buying? They're saying minimum 25 lakh or 30 lakh investment. Okay, fine. How do I get to know what is the real worth of that 25 lakh? Because I'm not going to get a specific property, right? I'm buying a fraction of the total property. And the value of that total property is not decided by us. 1, we cannot negotiate. 2, it is not decided by us. So 3, if that company chooses to charge me a higher amount for that same property, I cannot negotiate. So if I cannot negotiate, I am surely paying a higher price, right? So that yield that is coming to me, it can easily be played in such a way. It can be easily played in such a way that the 10% rental yield of the retail rental that I'm going to get might just be coming from my own money, which is rotating into this, right? So if I'm buying a property for 120 rupees, which is worth 100, the 20 rupees can be used to give me a higher rate of return. That is where I feel I'm not very happy with options like Strata, because I don't know what am I getting. Now let's talk about REITs. Now, REITs is better than options like Strata because it gives you a choice where you want to invest, and whatever price you invest, the lower price you invest, the higher yield you get, the higher price you invest, the lower yield you get. So the whole idea is that REITs can be played smartly. You can patiently wait. There are 3 REITs listed. There's Brookfield, there's Mindspace, and there is Embassy, obviously Embassy. So Embassy being one of the prime ones that we like, right? We sat out and we're still sitting out to wait for the right price to come. In the future, we can look at other ones too. So the whole idea is that here you have control over price because the price is not in anyone's hand. It is listed on the exchange. That's when it becomes fairer. That's when you know how much yield you're going to make. That's when you get to also choose a price from where the appreciation is also likely going to be higher. So this is one of my favorites, REITs, but the valuation is where my key focus is on. If the valuation is not in my favor, I will not invest. Then let's move to invoice discounting. So what is invoice discounting? In simple words, invoice discounting is that if one company has received an order from another company and they've received the invoice for it, they're creating the goods value and they're going to give the products to that company, and then once the products are delivered, they will get their money back. So once they have received the invoice, they received the order, they will give this to either a bank or a private financer or an invoice discounting platform to get that money upfront from you on the assurity that the person who gave them this order will pay, basically. So what are the steps involved? First, the vendor raises the invoice for goods sold to its client or buyer with a credit period of 30 to 90 days. Then the vendor approaches the platform to get cash. This is where the discounting is happening. The platform lists the invoice after carrying out due diligence. Investors express their interest to purchase the invoice at a discounted price, which is you. Let's say if the invoice is worth 1 crore rupees, this 1 crore will come after 90 days. You say, today I will only pay you 85 lakhs. So this 15 lakhs is basically the money you will make after 3 months, because you will get paid from the person who is supposed to pay to the company making the goods and services. So the company making the goods and service will get 85 from you, and the initial person who raised the invoice, the company who is due to pay the vendor, you will get paid from them. That is how it works. So here, the invoice, the price, the investor like you take the interest to purchase the invoice at a discounted price, like 1 crore by 85 lakhs. Step 5, investor transfer funds through escrow account and the vendor receives this discounted money. Now this 85 lakhs moves to the person making the good and services. On the invoice maturity, let's say 90 days are over, the client or the buyer pays the full invoice value to the vendor. Now this vendor is actually the platform. The platform through the escrow account pays you the money, because the money is going to be distributed into many people like you. This is how invoice discounting works. Now, how it is being done these days, like this is one company, one Kirana Bazaar. Their buyers are retail stores. Minimum investment just 1 lakh. For 90 days, you can invest as much as 2.5 crores. For invoice settlement up to 6 September, you get a 14% return. So Pragati Infra Material is another vendor. Their buyer is Z-Work. So one particular company, again 1 lakh, 90 days, 13%. So you're seeing very short tenures. Like this is a little old data. So this is somewhere from June when I got this data. So 1 month, 3 months, you can see 30 days. So this article must be somewhere in the lines of 6th June. So again, 30 days may you make 11.74. You don't get, this is IRR by the way, you don't get 12% total. If it's 12% and you're lending for 1 month, means how much percent are you going to get for 1 month? In absolute terms, you should be able to answer this. I have bright students. If the annual IRR is 12% and you're only lending for 1 month, what would be the absolute return you're going to get? 1%. Yes. So effective is 1% for that month. But the IRR is calculated for the year. So that's how it works. So the third is Calpro. Again, this is they're giving their money to Britannia and Herbal Nutrition. So this money, again, 45 days, 30 days, different returns are almost the same. So that's exactly how this is happening. So what we intend to do is, should you invest into this? There are other platforms as well. I looked into TradeCred. They are claiming up to 14%, and they said we've had 0 defaults so far. So the good sides of this is it's a very extremely short term, like 3 months, less than 3 months, 30 days, 45 days, 90 days. So, अब इस केस में क्या होता है, Jomonising Falcon is another one, wonderful. So इस केस में क्या है कि आपका अगर tenure extremely short है, तो you can make higher returns, and the promissory is also good so far, but it is all dependent on that one company. And again, this is not a secured option. This is also still unsecured, because this will further go into litigation later if the company chooses not to pay against the goods and services. So that thing can drag out for years if in case it defaults. So, and the probability of default is marginally higher than simple investing into a company, like direct investing into a company, because ये vendor management side है. I'll tell you something very interesting. I have shares of Britannia which have given me bonds of Britannia as bonuses. But if I have to, would that mean I should also lend my money as a vendor to Britannia, like in this case? Not necessarily, क्योंकि तीनों का risk अलग-अलग है. When I'm investing into the shares of Britannia, I'm taking the growth risk of the company. When I'm investing in the bonds of Britannia, I'm taking the default of the company as my risk. When I'm going into the vendor risk of Britannia, that's a higher risk than both of these put together, even more than so company can still grow. The company will still not default, but they can choose not to pay a particular vendor. That is also possible. So, isme legality plays a very big role. If they later say we did not like the goods and services you made, now what do we do? If the manufacturer genuinely did big mistakes in making this, they will not pay. So, wo wale issues aa jate hain. So, those are unforeseeable legal issues which can come in this. That's where I don't feel very comfortable. Even if it is the same company whose stock and bond I own, I still might not give the money to Britannia in that case. So legality is a bigger issue here. Now let's move to the fourth one. This is asset-backed leasing. So what is asset-backed leasing? So इसमें step number 1 क्या होता है कि a partner approaches the platform for leasing the asset or equipment. So this, I can give you an example, like I could be a manufacturer of earth moving or drilling equipments, you can say. Okay? Or earth movers like JCB. Have you seen those big earth movers with which construction is done, roads are being made, road rollers, Caterpillar, JCB, earth movers, all of those. You can just picturize that in your head. Let's say I am a producer. So the partner approaches the platform for leasing. The partner is the person producing, like JCB, or a person who is, you can say, the showroom of JCB, the person who is buying it from JCB. The person has 30, 40, 50 Caterpillars or earth movers or road rollers. Now they want to lease it on the platform. So that's step number 1. Second is the platform creates, again, special purpose vehicle for exclusive purchase and leasing of the equipment to partner after entering into a lease agreement with them. Step number 3, the investor on the platform transfers the funds to the SPV to participate in the deal. First, step number 4, the SPV issues NCDs to the investor, the person who is actually going to invest. Step number 5, the special purpose vehicle leases the asset equipment to platform partner, the person who needs it. Okay. Step number 6, the partner pays regular lease rentals to the SPV for using the equipment as per agreed terms. And finally, the SPV distributes the proceeds to investors for the value they've leased. So effectively, what is happening here is the person who has the asset, they're putting the asset into the SPV. The person who wants the asset, they are going into a contract with the SPV and saying, we will give you X amount of money every month to uh, not own it but lease it from you. So we don't want ownership. आजकल गाड़ियों में भी ऐसा होता है. You know, you don't have to buy a car. You can just lease a car for 5 years. So whatever money you will pay will be just as a rental. 5-year rental is basically what you're getting. After 5 years, they take the car back from you. It's exactly the same thing. But here it's not a car for personal use. Here it is equipment, or like an example I gave you of earth movers, road rollers for construction. They use that for the period of the project, and then they only pay rental for that tenure, and they don't have to manage the equipment after that. The equipment is taken back and then further given to someone else. This is exactly how it works. So there are asset-backed leasing platforms here as well. So there is Zip Electric, which is a company who is listed on Grip platform. Just a 25,000 minimum investment. For 2 years, you can get 12%. This is 2-year electric two-wheelers. Then all of these are on Grip itself. Lightning Logistics, Drink Prime, 91 Springboard. 91 Springboard is, by the way, also what do they call it? A co-working space. So the IT equipment they fund through this. Three Wheels United, three-wheeler electric. So 2 of them are in electric. 1 of them is back-end of co-working. Drink Prime is a water purifier. Again, 2-wheeler electric. And Everest Fleet is into CNG cars. So effectively, you will see most of 80% here is actually from the automobile industry. So if the automobile industry does well, you're going to get your money. If the automotive industry doesn't do well, again, there are questions to be raised. And returns you can make from 12% to 18%. When tenure here is longer. Now you're not talking 30 days, 60 days, 90 days. You're talking 2 years to, 2 years to 3 years, typically for that matter. But the amount size is extremely small. It's just 25,000 rupees. So this is it. What are the pros and cons into this? Well, tenure is long. Dependence on one single industry, especially electric, is a very dynamic industry. So I was quite excited when the electric industry started doing well. Only later to realize that the two-wheeler electric is facing major backlash. Why? Because Ola Electric, you saw so many. Have you seen the scooties burning? Have you seen those two-wheelers burning? Have you seen the news where the transport minister, the people in the industry are making very critical remarks, and a regulation is now going to come for two-wheeler electric companies to make sure that this does not happen. So more regulations means less production, more R&D cost, and the investor confidence also goes down. So possibly a short period less sales as well. It also means the replacement cost of the people whose scooties have been burnt out, and legal claims by those people, and maybe an entire rollout of the first fleet that they've given to lakhs of people. All of that. So the ripple effects of this is major. These things you can't really foresee. The more dynamic, आपको returns इसलिए मिल रहा है because dynamic बहुत ज़्यादा है. There are too many factors at play. So we need to understand those dynamics. Like a water purifier might be a more safer bet because it's a necessity than a two-wheeler electric, which is an upcoming thing. So these are the factors one really needs to take into play before the decisions are made. Now, option number 5. What is option number 5? Low-rated corporate bonds. So this is something you are already doing. But you're not going for low credit rating, you're going for a high credit rating or medium credit rating with a good average yield or a high yield. So like a little opposite of this. Companies like Aradan Financial Solutions, they say you just invest 10,000, invest for 15 months, but a BBB minus company, and you get 10.5%. Can you see how bad that is? just to get 10.5%, they're going for as low credit rating as BBB minus. What you guys are getting is AA, so BBB minus, BBB plus, AA minus. Can you see you've moved 4 credit ratings to get a higher return than this of 12.5% from Edelweiss, where these people are giving BBB minus mein just 10.5%. That's pretty bad from that context. Again, Ozexo Financial Services, 2 years ka bond with A plus. So in fact, my mistake, I didn't tell you, BBB minus, BBB plus, A minus, A plus, then AA minus. So it's not 4, I think it's 6 or 7 ratings up. Then you go into Ozexo Financial Services. You are, again, this is an A plus bond, just giving 9.5%. We have AA bonds giving 9.5%. In fact, AA plus bonds giving 9.5% to 10%. Then again, a BBB company giving 11.5%. So it's a really loose proposition because for the same or lower return, you're taking very high risk. Does not make any sense. I always say risk-adjusted returns. Returns don't matter. Risk-adjusted returns matter. You can get, some of you have also invested in that bond, which is going to give you 300% returns, right? The SREI infrastructure bond. But that's a risk-adjusted return. Because the risk is it can be 0 too. There's a chance. But we've done our research to ensure that we've got to a certain stage where there are interested buyers in that company. So that's risk-adjusted return. It's not just return, it's not just risk. Risk in conjunction with returns. That's how you make a decision. And the factor should be in your favor, obviously. So even companies like Went Wealth have this option, like you can get 12% or more returns. The problem is that low rating in a economic slowdown like this, exponentially increases your chances of default. And if you really want to take a default chance, then you should go for the SREI type options, where at least the risk-adjusted return is so high that you're able to get compensated for that bigger loss that can likely happen. That is what the ideology should be.